Rajat Sharma from Securities as well joins in on the show right now. Rajat, hi, afternoon. Good to have you on the show. Reliance, Rajat, what a fabulous move, and it continues to do so. 3 checks in the last 3 weeks. Seems like they're going to be debt-free in no time. Still time and opportunity, you think, to buy into Reliance Industries?
No, I don't think this is a great time to buy because, what's happened is, as you said, they've done a lot of these deals. A lot of money has come in. People are factoring in that they'll be debt-free in no time at all. But I'd be a little careful on their, business going forward because their core business is not going to perform anytime soon. Refining and petrochemical is still their core business. So a lot of what's happening in the price is based on, the short-term news of one after the other funding coming in. And again, business-wise, they're going to be doing something with geo platforms, which has already been tried and tested, and company after company have actually failed on doing this. Now, with Reliance, with the kind of deep pockets they have, they may just succeed, but this is nothing innovative or new that they're going to try with geo platforms and all this money coming into. Having said that, a lot of big players are putting in money, so they do see business sense in that. My only fear is that the way stock is running up is, again, people feel Reliance is just too big to fail. People are betting big on this. Otherwise, nothing justifies this stock to be close to its all-time high, really. It is close to its, I think, 3% from its all-time high. In a market like this, I think going forward, there'd be some cooling off in this stock for sure. So right now is probably not the best time to buy. Also, they're going to come out with a rights issue at 12.57. So there will be some cooling off in the price here.
Sure. What about Pharma though? Because there's renewed optimism which has lasted over a month now, Rajat. And not just that, you're seeing clearly an easing of stance from the US FDA as well. Case in point being the EIR that DRL got for its Srikakulam facility, which is clearly a big positive news.
No, absolutely. And I think the US FDA cannot afford to, block off any pharma companies, let alone be Indian or otherwise. And, if you see the last 3-4 years, pharma has been consistently underperforming at the back of exactly that US FDA warning letters, inspection letters. And now, if the world has to come out of this, pharma has to get us out of this. These stocks are trading extremely cheap. If you compare where these stocks were late last year to now, they've appreciated a lot. And for once, we've been on the right side of trade on this. I've been talking about this for a long time. This was a sector which was really cheap in terms of valuations last year. Now, personally, if you ask me, I think we're starting a very long bull market in this sector, the kinds we saw up until 2015-16. So I think pharma will again start a bullish market, which will go on for a long term. Yes, I don't know technically if the momentum is really strong and there could be some fall in prices from here. I don't know. I'm no one to comment on that. But fundamentally speaking, a lot of these companies have no debt on their books. The environment for them is improving a lot, and you cannot go wrong with buying 3-4 of the top 5 stocks and hold them in your portfolio. Also, these are stocks which the demand for the products of this is not going to go away anytime. So for once, you have to get back to basics of investing, buy things the demand for which will be there for a very long time. As you said, regulatory stance is easing for them. So this is definitely one sector where investors should put in their money and just hold on to it.
Rajat, hi there, good afternoon. What's the take when it comes to auto? Because that's a sector that's already reeling under the burden of low demand, there's high inventory, and now staring at another problem with respect to the regulatory challenges which have come into effect in the month of April. What's the road ahead for this sector as a whole, and are there any particular names that you'd advise?
Yeah, so, I've already bought a few of these stocks. I spoke about it last time. Hero MotoCorp was one, Tata Motors was the other. And all of these stocks that I'm talking about are purely based on valuations. I know the demand is not going to, in fact, to be honest, I think if you take China as an example, the demand is going to revive fairly quickly once this lockdown gets lifted. That said, a lot of these companies have a lot of debt on their books. So that is the only problem I see. Otherwise, I don't think there are any companies which are going to be able to replace the existing lot of companies and come up with products that will eat into their market share. So long as the market for auto remains, it will be these names, these companies which will do well. Right now, the sentiment is so bad for the auto stocks that, I can't think of or fathom anything that can go wrong for them from where they are. What can factor in more that could go wrong for auto? I mean, there's no cars flying on the roads. So right now it's, that saying buy when there's fear and buy when things look really, really bad. If you truly believe in that, you would actually be buying right now. And the way markets have fallen from 12,000 to 9,000, you're getting the whole market at a 25% discount. So if you were to buy today and hold on for 3 years, why should you be worried about another 10-15% fall in the market? I think what's happened is things have not gone as per the plan. And when things don't go as per plan, that's when best opportunities get presented, and auto definitely falls in that space. The herd mentality is stay away from this because it can get a lot worse. Earnings are not going to improve. A lot of companies will not be able to pay back their debt. I don't think I'd make such a bad picture of this, because if economy has to revive, it is in the interest of the government and in the interest of the world that a lot of these companies come out of the problems that they're facing. And I'm pretty sure a lot of these companies will do that. Last time also I said Hero Moto, one stock where two-wheeler demand in India is not going to go away. So what are you going to do? Create a new company? How long that will take to, feed into the demand that's there for the products that these companies make. So right now, you don't have to deep dive into the balance sheets and profit and loss statements of these companies to know they're available cheap. You should buy them and hold them for 3-4 years. Even if they fall 10-15% from here, don't follow the herd mentality of waiting for that and then buying. You're getting it at a quarter of a discount. Buy it.
All right, that's the view coming in on some of those auto stocks. Pull up Reliance Industries, a lot of resilience being witnessed in that heavyweight today. As remember, it's been given, Jio's been given the third check in less than a month, and American PE giant, that is Vista, is going to buy about 2% stake for close to 11,300 crore rupees.
Now with commercial real estate not really finding favor in the market, do you think you would apply this time to buy into any of the realty names?
Not at all, because the point I was making was stick to companies where there is no debt on the books. In fact, hunt for cash. Look for companies which don't have problems with rolling over of their debt or NCDs or bonds. Now, real estate as a sector is a very capital intensive sector. A lot of these companies have a lot of debt on their books. And post-COVID, there could be, I was reading a report, there could be about 20 to 25% correction in real estate prices across the board. So the margins for the inventory would sort of shrink for these companies, and anyways there would be no demand going forward on immediate basis. If we're talking of an environment where there's going to be job losses, where there's going to be pressure on companies to retain their employees, I don't think real estate can do anything great. In fact, I think that sector could actually struggle with the kind of debt that there is. As I said, the point I was making was look for companies where the demand for the product is going to remain, and there is no problem with debt. Markets have fallen 25%, and you have a lot of these stocks which have corrected a little. I'll give you an example. Marico, Britannia, HUL. These stocks, HUL has not fallen much, but Marico, Britannia have come down a little. The demand for their products has not gone anywhere. The demand for their products remains as robust as it was before COVID. Maybe it's probably come off a little, but they don't have any problem with debt on their books. So there's a lot of sectors, a lot of companies. As I said, hunt for cash, hunt for companies which do not have to, will not go into the problem of paying back money to their lenders and stuff. And real estate definitely is a sector you should definitely, stay away from at this point.
Sure. Where else have you been a buyer in this market fall since March?
Yeah, so since March, I've bought a few auto stocks. I've bought pharma stocks, but again, I had pharma stocks all of last year. It didn't look pretty towards the end of last year, but it's all paid off because, it's actually gone diametrically opposite to how the overall market has performed. I've held on to my stocks in the IT space. We're still sitting on a lot of cash. but we're incrementally deploying it in, again, as I said, companies where there is no debt on their books. And I think IT, Infosys and TCS, those kind of stocks, I think I would really at these prices want to go out and buy a lot of financial services and banking stocks. I'm holding on to Federal Bank from a higher level. I'm holding on to Canfin Homes from a higher level. These are stocks that I've liked. I would like to add more into this. And right now, I'm sitting at about 40-45% cash on most client portfolios. And that's really the key to this market that I'm talking about. It's come down about 25%. The reason why people are not buying is they expect it could go down a lot more. Because of what's happened is, and this is world over, I forget the name of the report again I was reading, which said HNI investors across the world are sitting on a lot of cash to deploy when there is a correction. So imagine the kind of money that will come into the market once this lockdown gets done or we have some kind of solution to the COVID problem. I don't know if the economic recovery will be V-shaped or not, but by the looks of it, it looks like the markets will recover in a V-shaped way because purely on the liquidity rush that may just come in. Having said that, nobody knows how long this goes on for. Again, that's the key. If this goes on for 6 months, 8 months, a year, then things could get ugly. But right now, where we are, if we find a resolution to this by September, October, I expect a lot of companies which have not seen erosion in demand for their products and don't have a debt problem on their books, those kind of companies will do really well in this environment. And whenever you find a resolution to this. So stay away from debt. I think that's the key.
Okay, I just want to also pull up the Nifty Bank because it's broken into the red. You've got names like RBL Bank looking rather weak. There's Bandhan Bank as well, Bank of Baroda, Axis Bank down about 3%, SBI too is at the losing end. Come in, Kunal, with your take on the reading of the Nifty Bank as well as some of these weak links in trade within the banking universe.
Yeah, I think now the markets are trading in a manner of gaps. Avan, I think the last 4-5 days we've just about seen gap movements on the Nifty. So, for example, case in point, what happened on Monday, the previous Friday, the markets closed on a much higher note. We were almost at 9,815. We were just about touching distance of breaking that 10,000 mark. And on Monday, we saw a sharp gap down. And post that, I think for the remainder of the session, we saw the markets muted. Today also it's very similar. So the Bank Nifty opened at, I think if I'm not wrong, 400 or 500 points up. At one point, it was just about in touching distance of breaking that 20,000 mark, at least on spot levels. But then by the end of the day, so currently we are flattish to negative on the Bank Nifty. We've come back to that 19,400 mark. So broadly, I think it's just about getting into a gap kind of a behavior for the markets, where if you're on the right side of the market positioning, then the opening gap of the next day favors you, and if it doesn't, then you end up losing out in the first half, and then there's lack of participation. So for Bank Nifty as well, I believe that we are trading in this 1,000-point band. In the morning, we were discussing that 20,100 is a very, very important resistance. So it's not a price-wise resistance, but it's more of a volume-weighted average price, which I believe is a very important category to look at in a market like this, which is consolidating. And 19,000 or 18,000, 19,100 on the Bank Nifty spot levels is the next level of strong support. So I believe that this 1,000-point band for the Bank Nifty is where it should be trading. At the upper end of the ranges, I think it's much more prudent to try and take a contrarian view. And if the Bank Nifty comes back to that 90,000 level, I believe as a short-term trader, you should try and take contra buy calls over there.
View coming in, and speaking of banks, you've also got ICICI Bank, the limelight on this one in tomorrow's trading session, as it will